Today is Saturday, January 4th, 2020. Today's session title is 2020 Starts with Market Volatility, and this is your 2-minute drill. Hi, I'm Jonathan Gurney, Portfolio Manager at Gurney Financial. The purpose of these videos is to educate and keep clients aware of what is happening in the stock market. Our goal is to close the gap in communication between clients and the actual person managing their assets. We use fundamentals primarily and technicals as part of our analysis. We hope the charts and education help clients and viewers alike. Friendly reminder, this video is not to be taken as financial advice. Should you have questions, feel free to reach out to us through email or social media comment section. We just released a new website at gurneyfinancial.com. Check it out if you wish to stay updated. So let's get into it. Wow, was it ever an interesting start to 2020. Thursday, the first trading day of 2020, major indexes started off with a strong move higher, with risk on assets getting a bid. Our leading growth portfolio was up 1.81% on Thursday. We like when we start off the year that way. Then overnight headlines reported the U.S. airstrike on Iran, killing Iran's top commander general. This led to a plunge in overnight futures. Frankly, it was not a horrible thing that these events occurred after hours. I think it could have been much worse. But I believe the overnight event basically forces people not to make an emotional decision. So Friday, despite a down day, closed well off the lows, the overnight lows. All of our accounts actually handled the dip quite well as we shifted some assets to risk off areas like real estate and utilities after Thursday. While the indexes were high Thursday, the first trading day, real estate and utilities took a huge downfall. So we actually did add some there on Thursday. We continue to keep about 70% invested while 30% is in cash. While I hope we do test a little lower, as I believe more monies would come into the market at that point and lead to a larger midterm rally, the resilience at these levels has been quite impressive, and we got to be real about that. The thing that we continue to preach is don't make any emotional decisions until the 10-day moving average on the S&P 500, again, the 10-day moving average of 3230 breaks down on a close. We haven't seen that. Thursday night, when futures were down significantly, we went below the 3230, but throughout the day, we got well above that. So again, the key is on a close. Frankly, it was tempting to sell everything at the open for many. I even got some phone calls to say, hey, does it make sense to sell here, take some gains? Again, keep in mind, we have 30% in cash. So being patient, watching price action throughout the day often keeps one well grounded. And this was kind of a perfect example of that. So focus more on price action and less on the news, and it'll tend to keep you more grounded and typically leads to less emotional decisions. Again, while I hope we actually test lower, the optimism could make it difficult to see a 3 to 5% dip short term. With that being said, at the short term overbought levels, headlines tend to make these moves more dramatic, as we experienced Friday. As we go higher, we will trim some short term. Though midterm, we are quite bullish from a fundamental and technical standpoint. There remain opportunities present, but for us, we believe that there will be better setups in time. So there's kind of a risk-reward thing going on. We're seeing opportunities, but a lot of things are pretty high in price at this point. It doesn't mean they can't go higher, but again, that's where I'm saying if we go higher, we trim and just be a realist. Again, our goal is to spend less time in the market and wait for better setups. We're going to transition now into the 2-minute drill. 1 second, and we will transition there. Okay, first chart is the S&P 500, key levels that we want to watch. Again, this purple line that I'm showing you here is the 10-day moving average. Again, we said that was at 3230 basically, 3230 right there, 3230. And what we're showing here is we continue to test this level and it bounces higher. So even Friday we tested, went below there, but we did close higher. Do we remain overbought? We actually on this dip went down to 65. Again, we're viewing anything over 70 as a little bit overbought. It doesn't mean you immediately sell. We've obviously been over 70 for quite some time, which is why I slowly start shifting some out because it can remain here. And I do think midterm, this chart actually looks very good. But it could be possible, and be open-minded to testing the 20-day moving average or even the 50-day moving average, which would be a decent amount lower. It doesn't mean that the world is ending when that happens. These are just normal market movements. A chart we want to kind of reiterate that we've been showing. After 1.5 years of consolidation throughout the years, again, this is from 2000 to 2020, basically. After a 1.5 year period of consolidation, this often leads to a nice breakout. I mean, you're talking about advances of 56%, almost 38%, and now we're finally seeing one of about 10% after a year and a half consolidation. So from a technical standpoint, I do think this will be a good year, but we are a little bit overbought short term. So I'm still optimistic. I'm just also being a realist of the advancement that we've seen this fast. So that is my take there. Interesting chart here. This is over the last 2 months showing S&P 500, the red line, versus risk off assets. So recently, risk on assets like technology has really taken off recently. Financials have recently taken off. I actually like seeing this in real estate. Again, historically, real estate tends to do very well because it actually has a nice dividend as well. So I actually added some on Thursday on the big dip when it was down like 1.4%, and that proved to be a very nice day. So you're seeing, this is a good example. So the S&P 500 went up quite a bit that one day, and all risk off assets went down significantly. But when the S&P went down Friday, beyond staples, which staples did okay, but utilities and real estate hung in there. So again, it's good to be diversified and just be a realist in taking gains at some time. Another interesting potential opportunity. I'm not going to be adding a ton here because I think it's going to hit some headwinds. Anytime you attack Iran, you're going to have some probably advancements in crude oil, meaning the price of crude oil is going to increase. So we did see it go to about 64. It backed off a little bit, but it's really interesting. Could this be a bid? This is all MLPs, Master Limited Partnerships, which I'm highlighting the distribution there is 8.91%. So even if it doesn't move anywhere for the whole year, your distribution would be 8.91%. Not a bad diversifier in times like this, but it's kind of at a key level where it's either going to break out or probably back off a little. There could be an advancement here. I do like this trade more midterm, but I think we need to see an entire market little pullback of 2 to 3%. So again, the market doesn't care what I think. So you got to keep that in mind. That's why I have 70% invested. I'm just being cautious because we have had a nice move. So midterm maybe on this one. Short term, be cautious because we have seen a pretty significant advancement in crude oil, and it tends to struggle around 60 in crude oil. So keep that in mind. Gold, this was an interesting chart that we kind of showed you a few weeks ago, a classic cup and handle technical breakout here. So a cup, handle, breakout. We tipped you off well in advance, and look at the move we saw recently. So we said, about a week or two ago, this could be a 1 to 3 week hold. We are testing key resistance above at 146. It would not surprise me to see a little bit of a struggle here. Look how overbought it is. But again, during concerning times, gold tends to get a bid. Full disclosure, I do own some of this. Clients do own some of this, but this will never be likely a long-term hold for me. This will be a 1 to 3 week period, maybe a month, 2 at the most, and get out. I'm not buying physical gold and probably never will. So I hope that this session was helpful. Let us know if you have questions. We're going to conclude with this. While I like what I'm seeing midterm, it was a solid warning that the market doesn't always go up, and I think that was kind of an eye-opener for some people. It would not surprise me from a seasonality standpoint for us to go a little bit lower to sideways short term. If we go higher, we will continue trimming. Overall fundamentals are strong enough for an advancement higher. The corporate earnings will need to improve. Last quarter's expectations were so low that many companies were basically given a pass or a break for a not so great performance quarter. So there will be more pressure on this quarter's earnings. From a technical standpoint, we're holding up quite well. Wouldn't surprise me to test key support levels on trade drama. So we could see some sideways to downward movement. Don't be surprised if we see that. But midterm, I got to be cautious how much I sell because I don't want to miss the move higher. So that's kind of where we stand. Although we hate dips, remember they often lead to better and more sustainable moves. The question really is, are you consistently adding? That's market performance 101. If you're adding during these dips or just adding and waiting for me to, add these monies on dips, I'm not going to add monies unless we see another dip likely. So if you do that, you're going to tend to do well in the market. Keep it simple. As always, we will keep you posted on the day-to-day price action on social media. So pay attention to that. Let us know if you have questions. That is all we have for today. I hope this was helpful. Let us know if you have topics or questions. We are here for you. Thanks again.